everyone online is suddenly an expert at picking stocks. I don't know about you, but like my timeline is flooded with people who are like, I bought this at this price and look at me now, check out my jet. We saw it with like GameStop, American Airlines, AMC, and like more this year. Quite frankly, seeing these people get like allegedly rich makes FOMO so bad that it hurts. So like, I'm mostly a dummy who steadfastly sticks to these 5 tips, and it's helped me be right more often than not. Let me help you do the same. So my name is John Rettinger. I've been making videos in the online space for the better part of 10 years. I run a channel mostly focused on tech. It's got around 1.6 million subscribers. During that time, I've made a lot of mistakes with finances. And I wanna help you guys avoid those same mistakes, and whatever money you can spare, whether it's $5, $10, $100, or a couple $1,000s, you can make that money work for you and make it grow. And hopefully this channel can show you how. All disclosure as well, I am not a financial expert. Anybody who's looking to invest should obviously do their homework and make their own decisions. And that starts us very nicely with point number 1. Do your homework. I get it, no one likes homework, it sucks, but looking at some headlines or Morningstar rating is not enough. If you wouldn't throw hundreds or thousands of dollars into like one pull of a slot machine, don't do it with the market. Set your goal and work backwards with your research. Your goal is to find a good value, right? You wanna make some money on that stock, especially if you plan to hold it for a while, whether it's 6 months, 12 months, or even a couple years. Before you put faith in any company and your dollars behind that company, you gotta do your research. Reviewing a stock's fundamentals to monitor its viability, checking to see if it still has room in your portfolio. Do you have a bunch of stocks in a particular category? This isn't a simple stock purchase. You're becoming like legitimately a shareholder of a company. That's what buying a stock is. So as an investor, at least for me, and I think for everybody, you should be willing to do proper analysis. All right, so number 1 is do your homework. Number 2 is check how the company compares to others in its industry. If you're talking about Apple, for example, how does it look next to Microsoft or even Amazon? It's pretty easy to start at least. So begin by looking at an industry that's represented in the market and establish if there's future growth potential, right? Is this thing gonna grow and make money? Industry can be a really great screener, I think, when investing. But when picking individual stocks in whatever industry you're looking at, you gotta take a look at and a serious look at where that company fits in. How does it fare against the competitors, others sort of in that field? Is there advantage that allows it to stand out? These really important questions, at least for me, have determined if a company has an edge. Is that edge going to make money? And evaluate the growth of sales and earnings and check statements and cash flows to make sure that those sales are translating to actual cash earnings for the business. And if you wanna go like a little far ahead, if you're an overachiever, to make a fair comparison, you can line up competitors of the same size or market cap and view their performance during the exact same time period, usually the quarter before earnings are announced. Number 3, it's a really important one, debt to equity. Pretty much every single company, no matter what, carries debt. Even if they got billions in the bank, every company's got some debt. Amazon, Apple, all of it have debt, and they use debt as an indicator of a company's financial well-being, which I get sounds very counterintuitive. So watch out for companies with high debt levels relative to their equity, and that's sometimes called its debt to equity ratio number. So to find this number, and again, maybe you do need a little bit of a calculator here, but divide the total liabilities on a company's balance sheet by the total amount of shareholder equity. So if you've got a lower risk tolerance, so maybe you don't have a lot of money to invest or you can't take much risk, that number should be about 0.3 or less. So for example, look at the debt to equity ratio across an industry. In the construction industry, with its reliance on debt funding, a higher ratio is probably gonna be acceptable. You know, construction companies take out loans to build and they pay that back, so that debt number might be higher. Make sure that your pick is in line with whatever industry norms you are looking at. Number 4, P&E all the things. The P&E ratio is a valuation metric that shows like how well a stock's price is going to perform relative to the earnings. In fact, P&E stands for price to earnings ratio. When using fundamental analysis and values of investing strategies, P&E ratio, at least to me, is really a major indicator of whether or not a stock is going to be overvalued or undervalued. And it gives really a ton of insight into their market value and if it's worth it according to financial markets. To find the P&E ratio, a lot of websites will just show you what it is. But if you want to figure it out for yourself, you can divide the company's share price by its earnings per share. And so to give you some reference, if a company is trading at like 40 bucks per share and the earnings per share is $2.50 and the P/E ratio is 16. P/E ratio is helpful to compare companies in the same industry or sector. I know that talking about P/Es can sound complicated. There's math involved here, and there are new terms maybe you're not familiar with. But if I could sort of cliff notes it and bottom line what the P/E ratio means, it's this. Some investors will say it's better to buy shares in companies with a lower P/E. That means you're gonna be paying less for every dollar of earnings that you're getting. So in that sense, it's kind of like a lower P/E is, think of it like a lower price tag. Meaning it's attractive to investors that are looking for a bargain, but in reality, it's not always the case. So it's important to kind of understand the reasons behind a company's P/E. So if a company has a low P/E because their business is fundamentally in decline or flawed, then the apparent bargain might not actually be there. So the last one is long-term strength and stability, right? That makes sense. When you look at investing, especially if you're new to it, it's hard to not get stuck down in the day-to-day. Like from 1 hour to the next, it dropped 3%. The next hour it went up. It's huge ups and downs, and the charts can be very confusing and a lot of times very disheartening. But if you're looking to invest, generally, at least for me, I try to look at it on a longer term. Not day-to-day or even week-to-week, but months and sometimes years. And you're looking to pick a stock, look at the charts over the years and see if it's sort of trending in the right direction. If it's dipping, understand why it's dipping. Is it dipping because of rumors of upcoming tax hikes? When the whole market takes a downturn, that's probably okay. Is it dipping when other stocks in the industry are not dipping because there's a problem? That's something to understand. How it deals with leadership. Have there been leadership changes? How the companies handle dividends are all things to understand. So for me, a long-term hold company is Apple. Whenever I've got some spare money, I buy as much Apple as I can afford at that time. Apple's a company that's traditionally done very well the past 7 or 8 years. And I know for the most part, that is going to continue to grow. Even if week to week, month to month, it goes down, I still know in a few years from now, Apple is still going to be a company that is selling iPhones in very large quantities and selling iPads and Apple Music, things that people are still going to use, makes it a company that I can trust. And I don't get too caught up in those slight dips. I just look at it as a really good opportunity to buy. Look for those companies that you know and that maybe you use as a really good indicator of what stocks you should at least be considering putting your money in. So those are my 5 key things to consider, but they're like not the only one. If a stock I'm looking at like passes those 5 lists, I'll consider other things too, like dividends and sort of more deeper dives into their leadership, and then kind of my own knowledge of a business. Have I heard rumors of a new product coming out that I think is going to change a company, or rumors of maybe embargoes that might be hurting a company? These are all just little small things that sort of can add up to a bigger picture. And again, when I make examples, it sort of for me always comes back to Apple. It's a company that I started investing in and want to continue to invest in because I trust the company. And whether or not it's Apple for you or another company, find a company that you can trust. Find a company that you know has been there for years, has a history of growth, and that's a good company to sort of put your dollars behind. I know a lot of people like to put their money behind hot stocks that are growing quickly and they want to capitalize on that growth, sort of the Dogecoin of the market. And that's fun for days and weeks, but you look back on months, that's not generally a good recipe for success. These are just my thoughts and opinions from somebody who's had some failures and some successes, but these 5 key points, when I stay with them, has more often than not served me very well.